Hello and welcome to episode 472 of the Money to the Masses podcast with your resident expert, as always, Damien Fay, and me, Andy Leaks. Damien, welcome back and welcome us back. We're back from a week away.
Yeah, do you know what? I'm absolutely buzzing about doing the podcast today. I'm not saying that I'm not always buzzing, but definitely there are peaks and troughs in like lots of things in life. And I've come back, and I think it is the week off, and we've come back, and we've got so much exciting stuff going on in the background that I'm just really pumped to do the podcast this week. So, I will mention we've got things going on in the background that are very exciting. In the last episode of this podcast, I did talk about that we are going to be asking people to help test something very exciting in the next few weeks. So there's been a wave of you that did join our Facebook group, because we're going to put the announcement into the Facebook group to be able to get a selection of people who can help us. So if you've not joined already, if you do want to be possibly in that group of people who can help us with a new exciting project and test something for us, go to facebook.com/groups/money to the masses. And the other thing I just wanted to say before we kick on with what's on in the show this week is that I have also sent out some Money to the Masses mugs to the people who left reviews that we read out last time when we produced this show. So don't forget, do go and leave a glowing 5-star review of the podcast. And then if we read it out, you may well earn yourself a Money to the Masses mug.
And before we start, Damien, we probably should mention that we're a little bit late recording this podcast because we spent the last 20 minutes trying to decipher how to log into our studio lights. I mean, what has the world come to?
So if you look at our YouTube show, you will see that we've got very nice lights in the background. And if you look at mine in particular, I've got sort of a blue to green thing going on in the background. The way they work is that it's very clever that I can pick any colour you want. So if you want to see a different colour any given week, then do tell us whatever colour scheme and we will put it on in the show so you can change that. But it's all done remotely, effectively. So Andy, even though Andy is probably about 40 miles away from me, end up having to log into the lights remotely to be able to change the colour. So technology is marvellous until the point where you can't actually turn them on or off when you're stood right next to them. But anyway, that's sort of letting you underneath the curtain, seeing behind the scenes. But yeah, when you've been away, it doesn't always work quite how you want it to.
So we're here anyway. We're logged into the lights. We're ready to go. We're pumped for this week's podcast. So let's tell the listeners what's coming up on this week's show.
So I've got two investing pieces really this week. The first piece is in relation to market sell-offs and what to do in a market crash and really how markets behave. So a number of years ago, I did a piece of research. Actually, it was nearly 10 years ago. I carried out a piece of research to look at what happens in a market sell-off. Do markets rebound? How soon do they rebound if they do? And I've updated that for 80/20 investor members, and I want to give some of the insight to podcast listeners too. Now, the second piece we've done isn't a direct investing piece, but what it is, it's in relation to investment platforms. And so it's something called stock lending or share lending. And it's a activity where a platform, or you could even have a pension fund, actually lends out the shares that they hold. So it could be the shares that the members, the pension members have, or if you're an investor via platform, technically your shares could be lent out to other people, normally banks, investment banks, institutions, to bet against the market, to short the market. I want to talk about that, explain what it is, because it's something that could become more prevalent in the UK. And also, there's a question of ethics about it. So something that people want to be looking out for. And the final piece on the podcast this week, of course, we had the announcement about the energy price cap. So Andy, you're going to be doing a piece on the energy price cap.
Yeah, that's right. So Ofgem have announced the latest energy price cap figures, which come into effect from the 1st of October through to the end of December. We've had a little bit of insight as to what might happen beyond that into January. So I'll be looking at whether we've missed the boat really in terms of fixing our energy tariffs. And I'll let you into a little bit of a secret. There's some good news. There's still some time. We'll go into that in more detail later on in the podcast.
Okay, so kicking off with the first piece on the podcast, I'm going to be doing the piece that is relating to a market sell-off. So recently we've actually seen a stock market slump, and it was one of those things. I was on holiday at the time, and it's always good to be away when you're having a stock market slump, because it means that you aren't encouraged or tempted to start to tinker. Now, obviously, I've been doing this for a long time, so I'm not the sort of person that would be tempted. But for those of you who listen to me to say things like that, I want to give you some evidence that will reassure you as to how markets usually behave when you get a slump. Now, back in 2015, so we're talking 9 years ago, I carried out a piece of research for 80/20 investor members, where at the time I looked at the price moves of the FTSE 100 ever since its inception. So the daily movements up and down. So that actual inception date was back in January 1984. So now we're in 2024. I've revisited that piece of research. So now we're looking at 40 years worth of daily trade data. So if anybody wants to know what I get up to in my spare time, then this is what I get up to in my spare time. And I can give you the insights from that. Well, back in 2015, I looked at the data and thought, well, what the findings, how does the market behave in a slump? And at the time, I came up with a couple of summaries really about how markets behave. And looking at them now, what we saw is that after a market slump, so where the market would sell off aggressively, and I was looking at the 50 best and worst days in the market. So if you looked at the history of the price movements, if you took the 50 best days and you looked at the 50 worst days on the FTSE 100, wherever or whenever they happened, and you put them in a chronological order, was there a pattern? That's what I was looking for. And the answer is yes, there was a pattern. And in fact, when you looked at it and did the numbers, what you found is when the market suddenly sold off aggressively, typically it bounced back strongly after about 6 to 7 trading days. So another way of putting that is that some of the strongest days in the market come very soon after the worst or weakest days in the market. So you could look at that and take it as a reminder that if you panic in a market sell-off, there's a very good chance you're going to actually miss the best days if you sell out at the bottom. So some of you may have heard variations of that from investment platforms, but without the actual data to back it up. So that idea, if you miss the best days of the market, then obviously your funds and your portfolio underperform, but they come very close to the very worst days. And so now you've got those numbers. Now that's not to say that in every instant that the market sold off 6 days later you were going to get a rebound. Sometimes the rebound would take months, so it would take you a very long time to recover back to the levels that you might have seen before. But typically, if you looked at the median, so the median is not the average, that's different. The median is the typical, so what happens most frequently in terms of that strong rebound. One of the strongest days in the market typically comes within 6 to 7 working days. Now, the other thing that we found when we looked at the numbers back in 2015 is that the initial bounce back that you got after that sell-off usually took the market, the FTSE 100, back to about 1.8 to 2% above where the FTSE 100 closed on that initial bad day. So that doesn't mean that the market obviously didn't go lower, but after that initial day, that initial sell-off. But what it means is you sometimes get these strong rallies. And then some of that is down to short squeezes, which is something I'm going to talk about in the next part of this show. So anyway, I've updated this piece of research. So what do we learn? Have things changed? And actually, what's really interesting when you do a piece of research like this is that you can test it in the wild. And by that I mean that when you get a scenario like 2020, and how can we forget 2020 with the pandemic and markets just imploded. In fact, if those of you who were into investing back in 2020 will know it was the fastest bear market on record. So that means we saw a 20% slump in the shortest period of time. That was incredible. And obviously, for a lot of people, quite frightening at the same time. But it was research like I carried out in 2015 that you cling on to in those moments to sit there and think, will the markets bounce back? History suggests that they may well do. Well, what we saw during that period is, yes, we saw some days where there were heavy slumps during that year, because there was more than one day where we saw some of the worst sell-off. So, for example, the second worst ever day on the FTSE 100 actually occurred in March 2020, so the beginning of that slump because of the pandemic. And we actually saw one of the other worst days ever for the FTSE 100. So we had the second worst day ever, but one of the other top 6, so the 6th place worst ever day, was also in March 2020. But then when you look at what happened subsequently, the second best day ever on the FTSE 100 also occurred in March 2020. But like I say, it doesn't mean the market's instantly rebounded, because it didn't. We saw slumps in the market go up and down. It did take most of that year to recover the losses that we saw in that initial slump, but we did see a lot of the uptick during very close to some of the worst days as well. So what that shows is that it is true. It remains the case that we see some of the best days after some of the worst. We did see some of the rebounds happen within 7 working days, but there were others that took a little bit longer to unfold during that period. So the research gave you a shred of comfort during that period, and actually it was tested in the field again in one of the worst periods in stock market history, and it showed that actually we do see typically a rebound at some point in some of the strongest days shortly after some of the worst ones. So I'm not guaranteeing what's going to happen in a market slump, but when you look at 40 years worth of data, including some of the darkest and best days in the market, including periods like the financial crisis or the dot-com bubble bursting, even the COVID slump, then that does tend to give you a real insight into what happens in human behaviour. And so that is something, if you want to look at the full research, you can if you take out a free trial of 80/20 Investor. But if not, then hopefully the next time we get a bit of a market wobble, you can at least sleep at night.
Okay, so let's move on to our next investing piece then, and we're going to be talking about stock lending or share lending. It's becoming a little bit more prevalent in the UK. So Damien, you're going to explain exactly what it is and how it works.
Yeah, so this was a really interesting topic of conversation in the Money to the Masses office. So when we have our chats in the morning, because obviously we mostly work remotely, so we'll have a catch up with the editorial team, and we'll talk about what we're going to be working on. And then it came about because there was news that a particular platform was going to start stock lending, so you could opt into that. And then it got to the discussion of what actually is that. And then you suddenly realise when talking to everybody that it is one of those things that I don't think most people know, A, happens, or B, even what it is. So share lending or stock lending, they're terms that you will occasionally hear, and they're interchangeable. And what it is that when a pension fund, for example, or it could be a fund of some kind, it could even be an investment platform, which we're seeing now, when they have large quantities of shares, and it could be shares in a particular company, they can actually generate extra revenue by lending those shares to a third party. And that third party is typically something like a hedge fund or an investment bank. And the reason they may do that is, like I say, to earn a little bit of extra income. But the reason that the third party might want to borrow those shares is that they can then use them to short the market. So there are going to be various terms you're going to learn about here if you've not heard them already. For example, shorting the market. So what do I mean by shorting the market? Well, effectively, I mean betting that the price of a share is going to go down and making money on that. So if you think about it, how would somebody actually bet against the market? Well, by borrowing the shares from somebody that already owns them. If that company that's borrowed them then has those shares, and let's just use an example, let's just say Microsoft. If they're Microsoft shares, then they've got them at a set price. They could then, theoretically, let's just pretend all shares were £100 that were Microsoft shares. We know that's not the case. But if they then sold those shares, and they therefore exerts in its own way a bit of selling pressure, but that therefore is likely to push the price down. But obviously you'd have to do that on a significantly large scale. But if they thought that the share price was going to go down, if they sold the shares at £100 and then the share price did fall, and let's say Microsoft shares went to £80, and they bought back the quantity of shares that they'd actually borrowed from the pension fund, for example, there's a differential there. They sold them for £100 and they bought them back for £80. Therefore, there's a £20 differential. Now, you imagine that £20 differential, that's effectively a profit, because they can then return the shares that they've had, the Microsoft shares, back to the person they lent them from, which in my example, let's say it's a pension fund. So in that process, the pension fund has made a bit of money from lending its shares. The short sellers made their money on the falling share price of Microsoft. And obviously, there may be a question of what sort of collateral do they typically post, which they might have got back. It could have been things like government bonds, for example. And now that is something that goes on in the investment world, and obviously it's particularly prevalent in the US. And we're seeing a number of platforms, for example, that are coming from the US, which I'll come on to one or two of them later on, that are now starting to offer this kind of stock lending. So as a user, you could theoretically sign up to allow your shares to be lent. Now, what happens to shares if you lend them? Well, you do technically lose your voting right because you don't actually have the shares anymore. The other thing is that you can have a dividend, like a quasi-dividend, not a real dividend that's paid to you, but that can have tax consequences as well. And obviously the positives, if you do lend them out, then you obviously can get some money for doing so. Now, typically, some of these platforms are allowing people who use them. And the reason I mention it became in the news because Free Trade are now offering, you don't have to do this, you can opt in to the process of allowing the shares that you have to be lent out, and you make money a 50-50 split with them. Now, to use Free Trade, as they are the platform that were in the news this week that are offering this, if you had £1,000 worth of shares and you decided to sign up to allow yourself to make money from them via this stock lending process, then once you've got your split, you might only get about 10p a month from doing so. So you're not going to get rich from it. But you can see why large pension funds, for example, that are huge and have huge amounts of shares and assets might therefore want to lend out their stocks. But there's a whole ethical question about stock lending, because if you've been listening to what I've just described, you'll have noticed that the person borrowing them is actually betting or wants the share price of the shares that have been lent to them to fall. And so therefore there is people out there, and to a certain extent I agree, that if you don't want to be involved in a stock, you don't like Microsoft, then don't buy it, don't own it. But what you're doing by allowing stock lending is allowing people to actually bet against the assets that the people who maybe are pension fund members or your own stock portfolio, they're able to bet against that and put downward pressure, and therefore theoretically in the long run can cost you money. So that is what stock lending is. Now, the reason we also mentioned it, because there are more platforms coming to the UK that are starting to offer it. Now, we've not gone through every single platform that's out there and looked at whether they do offer the option or whether they don't. But some of them that do offer it are obviously Free Trade, Trading 212, Robinhood, Interactive Brokers, and Webull. Now, I can confirm two platforms that definitely don't offer share lending. One of them is Hargreaves Lansdown, and one of them is Charles Stanley. Now, as a next little bit of learning on this, now you can understand with short sellers why you get short squeezes, which links really nicely to the very first part of the podcast where I was talking about how markets behave. Now, let's say somebody was short selling, then they had maybe borrowed those shares, they'd sold them, in my example, Microsoft at £100 a share, and then the price they hope would fall. If instead the price started to rise, what they'd have to do is buy back the shares that they owe the person or the institution that they borrowed them from. They would have to quickly buy them back, but they'd have to buy them back at a premium, more than what they actually sold them for. So they're making a loss. But of course, what happens if that starts to happen quickly, and there are a lot of people short selling who then suddenly panic, then there's a flood of people trying to unwind their short selling positions because they might want to give the stocks back to whoever they've lent them from and close out the whole position. Then you start getting acceleration and people panicking and buying, and then you get lots of people buying at once. And if lots of large institutions start buying shares at once because they're trying to unwind these short positions, then it causes the price to skyrocket, and that is called a short squeeze. So that's why sometimes you see that, and very often after you've seen a very aggressive sell-off, then you'll see this squeeze come very shortly afterwards. That's what typically happens, as I just described in the first part of the podcast. So it doesn't always mean there's a fundamental reason why markets are turning. It could be because some people are being greedy and betting it will go lower, and they get that wrong and have to unwind their positions and they start to lose. So we've seen lots of this in things like GameStop, and we've seen these meme stocks out there. that is sometimes what's going on. All these different moving parts and two different topics I'm talking about today are interlinked. So it is something to bear in mind. Like I mentioned, the first time I ever heard about it was many, many years ago, but it was in relation to funds. So I was at a fund. They used to do lunches where you'd meet the manager, and they were talking about the fund that they had, and they didn't do this because they didn't believe in it ethically. So it's out there, you will see it. For most people, they won't even sort of pay much attention. Some funds use the technique of stock lending to boost returns. Others use it just to generate a bit of income. Same for pension funds. So something to look out for, an FYI, and it's worth just telling people because some people may be particularly averse to it. It may be a criteria with which they might want to choose a fund or a pension, or it could be an investment platform in the future. But if nothing else, you've learned what actually is driving markets.
Okay, so let's move on to the final piece of the podcast then. And we're going to be talking about energy, specifically the energy price cap and what it means for people going forward over the next few months. So if you're not currently on a fixed deal, then your variable tariff that you're on will almost certainly mean that you will end up paying the rates dictated by the energy price cap, which is currently 1,568 per year for the average dual fuel household. And again, crucially, that's for people who pay by direct debit. There's a slightly different rate for those who don't. But Ofgem have announced last week that the energy price cap will be increasing by around about 10% on the 1st of October. So it'll be rising to £1,717 per year on average for the dual fuel household that pay by direct debit. And it will stay at that rate now until the end of the year. So we're going to be moving into those winter months at that higher 10% increase from the 1st of October. So it begs the question then, what's going to happen to our energy bills? Obviously, those on a variable rate will see an increase. But is now the right time? Have we missed the boat in terms of fixing energy tariffs, and are there still deals out there? Because we talked about this in a podcast in June, episode 464, is now the right time to fix? Well, in hindsight, looking at the data that we've just had, it probably was. And Damien, not to be too smug, I know you and I, following that podcast, have both fixed our energy tariffs, and so we're looking at this news and we're kind of okay with it because we are fixed for 12 months.
Yeah, and Justin, you know, anyone who knows Money to Mass as well knows my brother, who's one of the other directors here. He's been saying, I didn't fix. Is it now too late? Which is what Andy's going to be explaining in a second. But there was a period where there obviously was some good deals, and also it was a slightly easier decision this time because with certain providers, and I was with one of them, there was no penalty for therefore trying to swap to an alternative tariff later on down the road. So that made the decision slightly easier for some people. So for others, it might be slightly different, but it wasn't too difficult a decision at that point. And in fairness, Cornwall Insight do give incredibly accurate predictions. Just days before they predicted it up by 9%. Well, I'm not going to split hairs. 10%, 9% is pretty much the same thing. So they have been good at predicting where things were going in the future. So Andy, in answer to that question, whether it's too late, it's not.
No, it's definitely not. So looking slightly further ahead, you mentioned Cornwall Insight there, Damien. They have produced some sort of numbers which are sort of crystal ball gazing into the future. The thoughts are that it is going to increase again come January. So we're not just looking at this 10% increase. We've obviously got potentially 4 to 6 months of winter coming up. There's going to be another increase likely going to happen in January as well. So with that in mind, let's look and see what is available in terms of fixed price tariffs. Now, we've got an article on the Money to Masses website. We update it regularly, at least a couple of times a week. We look at all of the tariffs available and we update the tables that are in that article. So we'll link to that in the show notes of the podcast. The first couple of tariffs that I just briefly want to mention are not fixed price energy tariffs. They're actually tracker tariffs. But where they are quite good is if you're not quite ready to fix or you're not in the position to fix, you want to hedge your bets a little bit, they do guarantee at least that you will undercut whatever the energy price cap is. So there's two companies offering tracker tariffs that we've highlighted in the article. EDF have a tariff called EDF Ensure. And what that does is it ensures, see what they did there, that your tariff stays £50
cheaper,
whatever the energy price cap averages over the year. So you're going to average over the year to save £50 on the overall energy price cap over the 12 months. So that's one to consider. Another tracker tariff that you could consider is from E.ON, and it's called the E.ON Next Pledge, and it guarantees to track 3% whatever the energy price cap is. So two options to consider if you just want to make sure that you're not going to be going up to the energy price cap. Consider those two. There are three other offers at the moment that we think are worth considering fixing, and they're from three providers, and they are Outfox the Market, Octopus, and British Gas. Now, bear in mind again that these were right at the time that we've produced this podcast, so do make sure you check out our article to ensure that that offer is still available for that particular provider. So Outfox the Market do a fixed energy tariff that works out approximately 10% cheaper than the new 1st of October energy price cap tariff. So you can fix at that rate and you won't even have to pay the new energy price cap rate. Bear in mind again on these, if you're fixing for those 12 months. So while you are making a slight saving on the October energy price cap, if the whole energy market changes and come January, it's unlikely, but come January rates significantly move down, you are fixed in for 12 months unless there is a no exit fee policy within that particular provider. Now, looking at exit fees, as we mentioned them, Outfox the Market on that deal, there is a £50 exit fee if you exit that fixed price tariff. Finishing off with the last two, Octopus, they have a deal that's available to new and existing customers with no exit fees, and that deal with them works out to around about 7% cheaper than the new energy price cap coming in October. So again, that offer is available to new and existing customers, and it slightly undercuts the new energy price cap. And the final one I'm going to highlight in here is British Gas. They have a fixed 12-month tariff that works out to be around about 5% cheaper currently than the new energy price cap coming in October. Now, they do have £100 dual fuel exit fee if you're exiting to another provider. But interestingly, with British Gas, you can switch energy tariffs within British Gas and not have to pay an exit fee. So if you switch to another one with the same provider, no exit fee on that. The article that we've got on the Money to Masses website is in depth, and we are looking at the tariffs on a pretty much daily basis. So make sure you check out the article.
Like you say, Andy, you've definitely not missed the boat. You've got the tracker tariffs, an option for those that don't want to fix, like you say, £50 below or 3% below the energy cap, but also those fixed tariffs that are still going to give a saving on the new tariff. So there is definitely not missed the boat. So if you are interested, like Andy said, go and check out the article, and then you can read more about it and decide what you want to do. So Andy, I think that is it for this week. As ever, do make sure you leave us a review. You do follow us on all of our socials, particularly Instagram, particularly TikTok, but also, do join our Facebook group, facebook.com/groups/money to the masses. And of course, don't forget to follow and subscribe to our YouTube channel. We've got over 10,000 followers on our YouTube channel, which is great given it's not one we particularly promote really strongly. So do make sure you go over there, watch the show, leave comments, and Andy and I will answer them. So that is it, Andy. I think that all that's left for us to do is say until next time.
It is. Until next time.